One of the wildest years in stock market history is now in the books. In 2021, there's no better time than the present to work on cultivating a balanced, diversified stock portfolio. Today, we will tell you about 7 stocks to double your money. Number 7. Cresco Labs. One of the easiest ways to go green in 2021 is to consider buying into cannabis multi-state operator Cresco Labs, OTC CRLBF. On one hand, the company has a small but rapidly growing retail presence. It holds 29 dispensary licenses and has 20 operational stores. Of these open locations, roughly half are located in Illinois. The land of Lincoln began allowing recreational weed to be sold a year ago. Acquiring Origin House in January 2020 allowed Cresco to come into possession of a cannabis distribution license in California, the most lucrative pot market in the world. This lets the company to place pot products into more than 575 dispensaries throughout the Golden State. If we assume that California regulators continue to work through existing red tape, Cresco's access to dispensaries can soar in 2021 without it having to do much in the way of legwork. Look for Cresco to push into recurring profitability in 2021 and make a run towards triple-digit gains by year-end. Number 6. KKR Company, KKR. KKR Company LP, New York Stock Exchange, KKR, is known primarily as a private equity firm co-founded by co-CEOs Henry Kravis and George Roberts. A book about the leveraged buyout of RJR Nabisco in 1988. However, it does a lot more than just buy companies, leverage them with debt, and sell them off. In the 9-month period ended September 30th, it increased its revenue by 155% to $3.1 billion, with 35% from management fees, another 41% from performance fees, and the remaining 24% from investment income. The 3 segments were improving by 34%, 103%, and 378% respectively. As a result of strong revenues and earnings year-to-date in 2017, KKR's book value per outstanding adjusted unit increased 13.6% to $13.80. In the past 5 years, it has increased by 41% from $9.82 in 2012. Additionally, with the closing of 2 new strategic investor partnerships in the quarter and continued fundraising momentum, our assets under management and fee-paying assets under management have increased 17% and 22%, respectively, year over year. From an earnings perspective, KKR stock is reasonably cheap at 8.2 times forward earnings. Should it continue to grow its 3 main revenue streams in 2018, KKR stock doubling in price is very much in the cards. Number 5. Mercadolibre, MELI. Nearly 15 years into its record as a publicly traded company, Mercadolibre, NASDAQ, MELI, continues to reward long-term investors. Shares of Latin America's Amazon are up 160% in the last year alone, and now trade 8,900% higher than its 2017 IPO price of $18 per share. Mercadolibre acts like a middleman, much like Alibaba's e-commerce business. I believe that its best days are ahead of it for 2 reasons. First, Latin America is recovering from its latest political crisis and is moving into growth mode with 2.4% and 2.7% GDP growth expected in 2018 and 2019, respectively. Secondly, I see Alibaba or some other large e-commerce player acquiring Mercadolibre in the next 2 to 3 years, which should keep its stock moving higher. It's up 73% year-to-date, better than Amazon, but trailing Alibaba. Investors have been leery of Amazon's bigger push into Brazil, hurting Mercadolibre. But the reality is, Amazon doesn't do nearly as well outside the U.S., And given MELI is the established e-commerce heavyweight in Latin America, they might be more inclined to buy it than fight it. Mercadolibre shares are expensive by traditional valuation metrics on account of its explosive stock appreciation, and the company now trades at 25 times sales. Number 4. Cloudera. Finding a company involved in the cloud that's valued at less than 10 times sales is practically impossible. The coronavirus pandemic demonstrated how important online and cloud access are for businesses, which coerced investors to pay insane multiples. But one intriguing name slipped through the cracks: Cloudera, New York Stock Exchange, CLDR. The thing about Cloudera is that it wasn't always a cloud company. Over roughly the past year, it's moved away from its legacy data platform and has pushed its new hybrid private cloud and public cloud offerings. The ongoing transformation allows the company to generate cash flow from its legacy operations, while also transitioning these enterprise customers into higher margin, cloud-native platforms. In the October-ended quarter, subscription revenue jumped 18% from the prior year period. Cloudera is also looking out for its shareholders with a $500 million share repurchase program. If fully completed, Cloudera could retire an eighth of its outstanding shares. Number 3. Organigram Holdings. Organigram NASDAQ OGI is a Canadian pot stock. Though Canadian marijuana stocks have been an awful investment up to this point, Organigram has a couple of unique advantages that could allow it to surprise Wall Street in a big way in 2021. One of the biggest issues with Canadian pot stocks is that they've been hamstrung by regulators at the federal and provincial level. The good news is that key provinces like Ontario have begun opening new dispensaries at a steady rate. In other words, the supply bottlenecks that have crushed margins and consumer demand should become a thing of the past this year. More specific to Organigram, it has just one major cultivation site, Moncton in New Brunswick. Having just one site allows it to be more nimble with regard to cost-cutting, production, and product mix. It wouldn't surprise me if Organigram's cost-cutting, coupled with the maturation of Canadian pot industry, allows the company to eke out a profit in 2021. With the shares so deeply depressed, it wouldn't take much for this stock to double. Number 2. Everquote. In the financial space, online insurance marketplace Everquote, NASDAQ Ever, could give investors an encore performance after rocketing higher in 2019 and mostly going sideways in 2020. The beauty of the Everquote model is that it's built to take advantage of insurers switching their customer-captured activity online. Though the company has historically generated most of its revenue from auto insurance, it's been shifting into new verticals organically and through acquisitions. For example, the purchase of health insurance agency CrossPoint in early September. The simple fact is that Everquote's platform is a win-win for both parties. It's a simple platform for consumers to quickly price shop for insurance without filling out a mountain of forms, and it's an efficient way for insurers to land motivated customers. Everquote offers sustainable double-digit growth, yet is valued at less than 3 times forward year sales. That's a bargain I suspect won't stay a bargain for much longer. Number 1. Teva Pharmaceutical Industries. Brand name and generic drug developer Teva Pharmaceutical Industries, New York Stock Exchange Teva, is a logical choice to bounce back in a big way in 2021. To keep things short and sweet, Teva's been clobbered in recent years by a bribery settlement, its association with the opioid crisis, and due to allegations of generic drug price fixing. That's not good news, but the company also has a secret weapon, CEO KKR Schultz. Since taking over, he's reduced Teva's annual expenditures by $3 billion and cut the company's net debt by over $10 billion. At this trajectory, Teva's net debt should decline from north of $34 billion in 2017 to potentially less than $15 billion in 2023. Aside from improved financial flexibility, Schultz should also be responsible for navigating Teva out of its legal mess. If the company can resolve its outstanding opioid and price-fixing lawsuits without much in the way of cash penalties, that alone could more than double Teva's share price. Teva Pharmaceuticals is an inspired choice for value investors. That's it for today. With a little luck and a lot of good work, these 7 names could double. Do share with us in the comments if you know about any other best stocks for making progress. Please subscribe to the Stock Advisor. Thanks for watching.